Very good morning, friends. So welcome you all to the classes of the Institute of Chartered Accountants. So today we have a very interesting topic with you, and it's a part of the consolidation. And we've got two standards to cover in the two consecutive classes with you. One is Index 28 and one is Index 27. Well, we're not doing it in the chronological order. We're going to first of all cover the standard on Index 28 with you, followed by Index 27. But before we start, I think let me, of course, give you a little brief on these two standards. As far as Index 27 is concerned, it talks about separate financial statements. And as far as Index 28 is concerned, it talks about the investment in associates as well as joint venture, how these are accounted in the consolidated financial statements. I think you would have seen the emphasis that when I am looking at Index 27, I said it is a separate financial statements. And in terms of Index 28, we're looking at the consolidated financial statements. Now, the first thing what comes to the mind is that when you're looking at Index 28, and we say it is investment in associate as well as a joint venture, I think I want to make one thing very clear. When would Index 28 get triggered for the purposes of the investor? Mind the words very carefully. I'm looking at when does Index 28 trigger in terms of accounting in the books of the, you can say, in the books of the associate as well as you can say the books of the joint venture. So I think first of all, let's do one thing. We're just going to the study material and you can see the unit number 6. And I think if I share you the page number, it is 14.143. On page number 14.143 in unit number 6, Index 28 is being dealt with. And I'm just first reading the scope of the standard, and I'll take some diagrammatic representation to make it very clear. It says in the scope of the standard that Index 28 shall be applied by all entities that are investors with a joint control of an investee. In the bracket, it says investee is a joint venture of the investor. And then it says, or a significant influence over the investee. And in the bracket, it says the investee is an associate of the investor. Now, I think just to relate it further and give you a little more inputs on that, I think let me just take it a slightly little further. Good morning, Rashmi. Good morning, Koshki. Thank you so much. So I think I'm just going to take a little diagrammatic view in terms of things. So you can note it down as well. I am looking at, you can say, the scope of the standard. So I'm going to take a total of 3-4 situations to give you absolute clarity when Index 28 is going to trigger. Now let's imagine there is a company A Limited, and let's imagine that there is a company B Limited, and company A Limited, let us say, is got a joint control over B. A along with other investor. Mind the words carefully. A Limited along with other investors. So I think let me put it like this, that A along with, let's say, C Limited is got a joint control over B. Now, let's be very clear. For the purposes of assessment of the joint control, mind each and every word carefully. For the assessment of the joint control, you would have applied Index 111. Index 111 makes you, gives you the principles in terms of assessing a joint control. Thereafter, you would have also classified this joint control either as a joint operation or as a joint venture. So we can say A, along with other investor, let's say C, is got a joint control over B, and the assessment of the joint control is done and the classification is done based on Index 111. Now, if you say that B is supposed to be a joint operation, we would still apply Index 111. But if you say that it is supposed to be a joint venture, then I would come to Ind AS 28. Mind it carefully. So the assessment of a joint control is done by virtue of Ind AS 111. The classification of the joint arrangement as a JO or JV is done as per Ind AS 111. But the moment you classify this joint arrangement as a JV, as a joint venture, then my Ind AS 28 gets triggered. Now, A as well as C, if they are classifying B as a JV, they need to account for this investment in the consolidated financial statements by virtue of Ind AS 28. This is situation number 1. Now let's have a look at another situation, situation number 2. So what is important is that for the investor A Limited, we should be able to say that B is a JV. The joint control results in a JV and not a joint operation. That is important. Okay. Another example is that there is a company A Limited and there is a company B Limited, and let's say A Limited is assessed to have a significant influence over B. Let's say A Limited is said to have a significant influence over B. Now, how would you make an assessment of a significant influence? The assessment of the significant influence will be made by virtue of Ind AS 28. The significant influence will be assessed on the basis of Ind AS 28, and now A in its consolidated financial statements would account for this company B, which is technically called now an associate. This company B, which is the investee company, is now going to be called as an associate, and A in the consolidated financial statements would account for this investment as an associate. And that is situation number 2. And I think if you go to look at the scope of the standard, this is very clearly defined. I think, let me just come back to the study map. It says investors with a joint control of an investee. That was my situation 1. That is, the investee is a joint venture of the investor, or there is a significant influence over an investee. That is, investee is an associate of the investor. I hope I'm pretty clear on the picture. Apart from these two situations, that when there is a joint control resulting in a JV, or there is a significant influence, there is another very third interesting situation. Would you like to know the technical situation which arises in the third case? I'm pretty sure you would like to know that. So I think based on what you've learned in Ind AS 111, let's give you a little tricky situation as well, where Ind AS 28 would apply. So let me give you a third situation, which is slightly tricky in nature. Now imagine there is A Limited, imagine there is B Limited, and imagine there is C Limited. So I'm taking 3 investors, A, B, and C. Let's say, for example, all these 3 investors identify that company D Limited is supposed to be, let's say, a joint operation. Let's say A as well as B identify, let's say they've got a joint control. Now, first of all, let me clarify one thing. It is identified that A and B have got a joint control over this arrangement. Mind the words carefully. It has been identified that A and B have got a joint control over the particular arrangement. Now, it is quite possible that, let's say, for example, A has got a 50% stake, and B has got a 30% stake, and C has got a 20% stake. And let's say we need a 75% majority in order to take a decision. Now, in this particular case, since we need a 75% majority to take decisions, we can say that A and B could have a joint control over the arrangement. Then the question what comes to the mind is, what about investor C? In this case, if A and B have got a joint control over the arrangement, then what do we consider the status as far as C is concerned? Possibly, C would be assessed that whether he's got a significant influence over the arrangement or not. because he is a party to the arrangement, but he does not have a joint control. The joint control of the arrangement is with A and B. So it is quite possible that in a given arrangement, let's say out of the three parties, A and B have got a joint control, then A and B would apply Indes 111 if it is supposed to be a joint operation. And A and B would apply Indes 28 if it is a joint venture. Mind the words carefully. So A and B would apply Indes 111 if it is supposed to be a joint operation, or they would apply Indes 28 if it is supposed to be a joint venture. But as for a C, who is a party to the arrangement, is going to apply outrightly Indes 28 because he's got a significant influence but not a joint control. I hope I've made myself very clear. I think let me consolidate the scope of the standard. So I've given you the three situations in order to identify when does Indes 28 get triggered. So one of the plain vanilla situations is that A with other investor C has got a joint control. Now, if the joint control results in a joint operation, then Indes 111 would apply to A and C. But if this is classified as a joint venture, then E and C would apply Indes 28 for their consolidated financial statements. So the moment you are classifying an arrangement where there is a joint control as a JV, then you're covered under Indes 28. The second is that A has got a significant influence over B, then B becomes an associate. And in that case, A would apply Indes 28. And a slightly tricky situation could be where some of the investors would be applying Indes 111 and the other investors might be applying Indes 28. Because in a given arrangement, let's say the third situation where A and B have got a joint control over the arrangement, then C is a party to the arrangement but does not have a joint control. In that particular case, we can say that C may be assessed for a significant influence and he would treat D as an associate and account under Indes 28. I hope, friends, I am pretty clear on the scope of the standard. When does the standard gets triggered? Clear? Wonderful indeed. Okay, now let's take the journey forward and let me first of all give you a mapping in terms of how we are going to proceed with this particular standard. Now, having understood the situations when this particular standard will get triggered, let me now first of all give you an insight of what we are going to discuss in this particular standard. Well, number one, we're going to understand how do you assess a significant influence. We need to understand that how do you assess that investor has got a significant influence over the investee. Let me first of all tell you one thing very clearly, that this is not a rule-based assessment. It is not supposed to be a rule-based assessment, but it is again a principle-based assessment. As you've already seen in terms of Indes 110, and in terms of Indes 111, that control or a joint control is also not a rule-based assessment, but it is supposed to be a principle-based assessment. Now, at the per se, the standard makes it very clear that generally, the words given in the standard is very clear that generally, if you say that as an investor, you've got 20% or let's say 20% plus investment in an associate, generally, it would imply that there is certainly a significant influence. So you can say, yes, there is a certain rule to that extent, that generally, if investor has got a 20% or more than a 20% voting power in the investee, then we can say that there is a significant influence, but it can be challenged as well. Similarly, we believe that if the investor is got below than 20% stake in a company, there is an absence of a significant influence, but it is subjective. There could be parameters which could prove that there is a significant influence when you've got less than 20. There could be parameters which could prove that there is no significant influence even if you've got more than 20. So on the very offset, you can say that Per se, if you've got 20% or more voting power, it implies a significant influence, but it may not be the case. If you've got below 20% stake, then significant influence is absent, but there is a possibility of getting a significant influence. So we'll deal with these cases. The second area of discussion in the standard is, once you say that a significant influence is established, does it mean that Ind AS 28 is mandatory? Does it mean that for the investor, Ind AS 28 is mandatory and it is required to present a consolidated financial statements where the investment is going to be accounted under Ind AS 28? No. I would say there are certain exemptions. Now, at this stage, I would like to, clarify one particular aspect, because this is where, sometimes we tend to get a little confused. Let me use another terminology at this end. There is a word which is called exception. There is a word which is called exception, and there is a word which is called exemption. Now, the question arises, what is a difference between exemption and an exception? Now, when you say exemption, exemption means that a particular company gets a choice. A particular company gets a choice. It's not mandatory. It's not mandatory. So when you say it is a case of exemption, it becomes that it is supposed to be optional in nature. I may apply Ind AS 28. I may not apply Ind AS 28. This is what is called an exemption. But when you say that it is a case of exception, it means no choice. It means no choice. You have to, on a mandatory basis, apply the concept. So this becomes a case of a mandatory situation where I would tell the company, boss, you cannot apply Ind AS 28. I hope you mind the words very carefully. I'm using the word exemption and I'm using the word exception. So we'll carefully understand that once a significant influence is established, in that particular case, which cases do you tell the company that you've got an exemption, you've got a choice, and it is optional, you want to apply Ind AS 28 or not. And then we'll also see the cases where it is a case of, you can say, an exception where it's not a choice. You mandate the investor that you cannot apply Ind AS 28. So we'll understand the exemptions and the exceptions in those cases. Let's see if under Ind AS 28 there are any cases of exceptions or not. But yes, exemptions are certainly there, where you get a choice in terms of not applying the standard. Second aspect. Then we go to the third area of discussion with you. I'm just giving you a flow of the standard so that, once we look into the standard, you've got a certain flow of understanding as well. Now, in terms of the section number 3, what we're going to do, once you establish that there is a significant influence, one, and you're also able to establish that we are not covered under any exemptions or exceptions, then you need to understand the accounting. How would the investment be accounted for in the consolidated financial statements? The focus in terms of Ind AS 28 is accounting in terms of consolidated financial statements. So we're going to see how the accounting of the investment will be done in the consolidated financial statements. And we use a typical method, which is called equity method of accounting. There is a particular method which is called the equity method of accounting for investment in the consolidated financial statements. So that's going to be number 3. We'll understand the accounting part. Then I'm going to go to the fourth area of discussion with you. And the fourth area of discussion in this particular case is going to be, what we can say is the change in ownership percentage. What we're going to discuss is the change in the ownership percentage. Now, when I say that there is a change in the ownership percentage, there could be various permutation combinations. And I think just to give you a little feel in terms of the various permutation combinations which would arise, it could be a situation where there could be a further acquisitions. It could be a situation where there is a further acquisition. Let's say, for example, you were a passive investor Let's say, for example, you were a passive investor and you were accounting for that investment under Index 109. And then you switch over, and with a further acquisition, you get a significant influence. Or there could be a situation, for example, you already have a significant influence and you acquire a further stake in the company, and the significant influence continues in this particular case. You had a 20% stake, you acquired another 10% stake, so you already had a significant influence, and the significant influence continues. Or maybe there is a possibility that we might look for, cases of disposals as well. Now, when you're looking in terms of cases of disposal, well, there could be another permutation combinations. For example, a significant influence turns into, let's say, a passive investment. You had a situation where there was a significant influence and you are now converted into a passive investment and you need to go back to Index 109. Or it could be a situation where the significant influence continues. That means you made a disposal, but still a significant influence continues in this particular case. Or it may be a case of a complete disposal as well. Just giving you a few examples of what could be the changes in terms of the percentage ownership. And last but not the least thing, what we're going to cover in this particular standard is, you can say there is a possibility that as an investor, you've got, apart from the equity shares in the company, other long-term interests. So we're going to see how the accounting for the other long-term interest takes place. So there is a very interesting illustration which is based on the appendix to the Index 28 and is covered in the study material as well, which considers the accounting in terms of other long-term interest which you may have in the associate. Wow. So I think we've made a list of 5 items which we need to study in this particular standard. It's a very interesting and an easy standard as well. So I think let me just correlate the issues to you so that we can start a chain of thought on this case. So as I said, we've got a total of 5 agendas, what we're going to cover in this particular standard. The first is going to be quite theoretical in nature because that's not, accounting. So that's going to be a little assessment. So the first thing is we need to establish a significant influence of the investor over the investee. So in this particular case, we'll see that on the very onset, it seems to be a rule-based accounting, but it is not. Generally, if you've got 20% or more voting power in a company, we would establish a significant influence, but it could be the other way around as well. Generally, if you've got less than 20% stake in a company, there is an absence of a significant influence, but it can be the other way around as well. So principle-based and not rule-based assessment. The second area is the most interesting part, that we need to understand that once a significant influence is established, does Index 28 become mandatory? Are there any situations where I would tell the company, okay, you got a choice? That becomes a case of exemption. And are there any cases of exceptions where I tell the company, boss, you cannot apply Index 28? So remember, when you say exemption, you're telling the company you've got a choice, optional. And when you say it is a case of exception, then you're saying, boss, you've got no choice, it's mandatory. So we'll see that what are those exemptions and exceptions in terms of Index 28. The third is we're going to learn the accounting aspect, how the accounting for the investments is going to take place under a typical method called equity method of accounting. And then we're going to see the changes in the percentage of ownership, where there might be further acquisitions, changing the status of a passive investor to a significant influence, or maybe the significant influence continues, or there could be a sale, and that could result in a loss of significant influence, or maybe it continues, or you convert into a passive investor. And finally, the other long-term interest in the company. Okay, so far so good. I hope I am pretty clear on my thought process. If you technically see, I have not given you anything so far. I've just created a base for the understanding of this particular standard. Okay, so I think now let's take the journey forward with you, and let me just come back to the study material once again with you, and let's start working on the first agenda with you. Now, if you go back to the study material in this particular case, we are given on the same page, and that is the assessment of significant influence. So let me just read this. Most of the conditions which are given is pretty simple and straightforward and doesn't need much explanation. It says an associate is an entity over which the investor has got a significant influence. Hence, to assess whether an investee is an associate or not, we need to understand what is a significant influence. And if you look at the definition which is given in the standard, it does not give you any percentages. It simply says that significant influence is the power to participate. It is the power to participate in the financial and operating policy decisions of the investee, but is not a control and is not a joint control. So simply speaking, we can say when the investor gets the power to participate in the financial and operating policy decisions of the investee, we can say it becomes a case of a significant influence. Now, I think let's take it further. So as I said earlier, that there is a basic presumption, but this presumption can be challenged. So there is a presumption, and when that can be challenged, it is called a rebuttable presumption. Mind the words carefully. I'm just giving you little technical terms so that you understand the accounting in a larger perspective. So when there is a presumption and it can be challenged, it is called a rebuttable presumption. So this presumption is something which can be challenged. It says if an entity holds directly or indirectly through a subsidiary. Now, something which is very important to tell you. And there is a clarification which is given in the education material as well. The Institute of Chartered Accountants has also clarified a couple of issues in the education material on this particular standard. So I'll be taking up a few questions from the education material also to give you a good, hold on this particular standard. Now, mind the words, it says if an entity holds directly or indirectly through a subsidiary. Now, let me just come back to the board and give you something very important at this stage. Let's say, for example, there is a company A Limited, and let's say, for example, there is a company B Limited, and let's say, for example, there is a company C Limited. Let's say A Limited has got a control over B. Let's say A has got a control over B. So B is a subsidiary of A. Now let's say A has got a 10% stake in C. And let's say B has also got a 10% stake in C. So in this particular case, you can say that A has got a direct investment. It is directly having a 10% stake in C, and it has got indirect. It has got indirect investment. It is indirectly having a 10% stake through C. So if A has got, let's say, an 80% stake in B, should we say that A has got 8% in C indirectly? No. Now, one thing we need to be on a very careful front, that when you are making an assessment of a significant influence, I'll add 10 plus 10. I'll not consider 10 plus 80% of 10. So for the purpose of assessment of a significant influence, we're just going to add the direct indirect percentage. So we can say that directly there is a 10% stake, indirectly there is a 10% stake. So we can say that there is a 20% stake. The significant influence is established. But when you go to account for the investment, and you go to consider that what does the stake A has got in C, then I would say for the purpose of accounting, we're going to say, yes, we've got an 18% stake in the company. Because A has got indirectly, you can say 18% stake in the equity or the net assets of C. So the assessment is going to be based on a simple addition without considering 80% of 10. But when you're going to account for that investment, then A's has got effectively an 18% stake in terms of C. Okay, this is one. Second important thing which I want to pinpoint at this particular stage, that when you're looking at the indirect investment should be through a subsidiary only. It should be through a subsidiary only. That's what the standard is put very clearly. And I think if I just come back to the study material, see what it says. If an entity is holding directly or indirectly through a subsidiary. The indirect investment has to be through a subsidiary. Otherwise, it is not considered for the purpose of a significant influence. Okay, for example, if I slightly give you a little more idea, let's say there is a company A Limited, and let's say there is a company B Limited, and let's say there is a company C Limited, and let's say there is a company D Limited, and let's say there is a company E Limited. And I think let's consider the percentage stakes like this. Just have a very careful look at this particular example, which is going to give you a very clear-cut insight that when you are calculating the significant influence percentage, what is to be considered and what is not to be considered. Now, let's say, for example, A has got a control over B. So B is a subsidiary. Let's say E has got a joint control over C, and let's say E has got a significant influence over D. So E has got a subsidiary, which is B. E has got a joint control over C, and it has got a significant influence over D. Now, let's say E has got a stake in E, which is 10%. B has got a stake in E, which is 10%. Let's say C has got a stake in E, let's say 10%, and D has also got a stake in E, which is 10%. Now, if you calculate the direct percentage, I would say the direct percentage is 10%. I would say the direct percentage is 10%. Now, if you say indirectly, I would say indirectly is 10%, indirectly is 10%, indirectly is 10%, but when you say indirectly through a subsidiary, this is through subsidiary, this is not through subsidiary, this is not through subsidiary. So if you've got an indirect percentage through an associate, if you've got an indirect percentage through a joint venture, for example, it is not considered. So in this particular case, A has got a direct and indirect percent through a subsidiary. So we can say he's got a 20% stake in terms of B. The stake which he holds through other investors, through the subsidiary, through the non-subsidiary, which is an associate or a joint venture, would not qualify for this percentage. I think emphasis added that the percentage held is to be direct or it is to be indirect through a subsidiary. I hope you mind the words through a subsidiary. That's going to give you a good highlight in terms of things. Okay, so I think the presumption is very clear that if an entity holds directly or indirectly through a subsidiary, so I think I've added my emphasis on the word through a subsidiary. So indirect investment has to be through a subsidiary only. 20% or more of the voting rights of an investee, then it is presumed that the entity has got a significant influence unless it can be demonstrated that this is not the case. And then it says conversely, if the entity directly, indirectly through a subsidiary has got less than 20% voting power of the investee, it is presumed that the entity does not have a significant influence unless the influence can be clearly demonstrated. So I think the standard has given us a rebuttable presumption that if you've got a 20% or more voting power in a company, you can say, yes, a significant influence is implied unless you can prove it to the contrary. And if you've got below 20% stake in a company, below 20, I'm not saying 20, because 20 and above is implying a significant influence. Below 20 means no significant influence unless it can be demonstrated otherwise. Okay. I hope I am pretty clear on the rule which is given for the significant influence assessment. Now, I would say there could be two kinds of cases if I come back to the assessment of significant influence. So I would put it like this, that you can get two cases. Case number one, where you say that there is a 20% or there is more than 20% voting power in a company, and we say, yes, significant influence is present, or there is something which challenges and says, no, it is not present. The other case is that you've got less than 20% voting power. And in this particular case, generally we would say that there is no significant influence, but yes, there can be a significant influence. So we need to understand only the exceptional case. I need to understand only the exceptional case that you've got more than 20, but still you say, no, there is no significant influence. You've got less than 20, but you'll end up saying, yes, there is a significant influence because we understand the rule. But I think we need to understand that what kind of facts and circumstances would lead to a different conclusion altogether. So I think for this particular purpose, we are given some questions out here in the study material, which I'm going to make a walkthrough with you. So let me just come back to the study material and let's have a look at the illustration number 1. So let's have a look at illustration number 1, where we can clearly see that a company has got a more than 20% stake in a company. And let's see whether it establishes a significant influence or not. It says E has got 25% voting power of an investee. I think my presumption is that if you've got more than 20, you've got a significant influence. The balance 75% is held by 3 other investors, each holding 25%. Now, let me also tell you something very important at this particular stage. If in a particular company, let's say one particular investor has got a control, or let's say, for example, 2 or more than 2 investors have got a joint control, it doesn't mean that other investors cannot have a significant influence. I think, let me just clarify this issue as well, though it is also very clearly written in the study mat, but I think let me make it very clear. Let's say, for example, there is a company A Limited investor, there is a company B Limited, and let's say there is a company C Limited, and there is a company D Limited. Now, if you say that A has got a control over D, if you say that A has got a control over D, it does not mean that B cannot have a significant influence over D, or C cannot have a significant influence. There is a possibility that in spite of A having a control over B, the other investors could have a significant influence. It is also possible, for example, B and C has got a joint control over D. Well, it's not possible that A has got a control and B and C get a joint control. That's not possible. So let's take another situation where B and C has got a joint control over D. Well, it can still imply that A can have a significant influence over D. So the possibility is we can say one thing, that one investor has got a control, still there can be another investor with a significant influence. Let's say 2 or more investors have got a joint control, still it is possible that other investor has got a significant influence. The presence of a control of other investor or the presence of a joint control of other investor does not mean that I cannot have a significant influence over a particular company. And if you see above the illustration number 1, it is very clearly given that it should be noted that a substantial or majority ownership by another investor does not necessarily preclude an entity having a significant influence. Okay, let's, I think, read it further with you. It says E has got a 25% voting power of an investee, and the balance 75% is held by 3 investors, each having 25% stake. That the decisions about the financing and operating policies of the investee are taken by investors holding majority voting power. Since the other 3 investors together hold majority voting power, they generally take the decisions without taking the consent of E. Even if E proposes any changes to the financing and operating policies of the investee, the other 3 investors do not favor those changes. So in effect, the suggestions of E are not considered while taking decisions relating to financing and operating policy. The simple concept is, if you ask yourself in this particular case, do you think E is able to participate in the financial and operating policy decisions of the associate company? No. Though he may be having a 25% stake in the company, but it seems that it's only a paper percentage. He's got a 25% stake in the company, but I think once it comes to the reality check, he is not having enough rights in terms of even participating, because people are taking decisions, the other investors are taking decisions without his participation. So in this particular case, looking at the facts and circumstance of the case, even though he's got a 20% plus voting power in the company, but I think the significant influence is definitely not present. So we can have a look at the answer. Since E is holding more than 20% voting power, it indicates he might have a significant influence. However, the other investors prevent E from participating in financing and operating policy decisions. Hence, E is not in a position to get a significant influence. So I think we cannot always go on the face of it, that on the face of it, you've got a 20% or more than that voting power. But that does not necessarily imply, because we said it's a rebuttable presumption, that a 20% significant influence, but not necessarily that it would always mean a significant influence. Okay, now let's have a look at some more inputs, wherein as an investor, you've got less than 20% stake in a company, but still due to other facts and circumstances of the case, you may still have a significant influence. And these are cases, again, where a little substantial judgment would be required. Now, the standard has given us some inputs, or we can say other factors which could indicate that in spite of a 20% less voting power in a company, you may have a significant influence. So let's, I think, read it. The assessment of whether investor has a significant influence over the investee requires application of judgment. And in making such a judgment, the investor shall consider the following factors which generally demonstrate the existence of a significant influence. Now, there are a total of 5 factors which are given in the standard. And on each of these factors, there is one illustration devoted to each of these factors in the study material. So what I'm going to do, I'm going to read the factor, and then I'm just going to read out the illustration to you. There is nothing too technical in terms of these things, but yes, it can be a substantial judgment. As we will go through these particular, illustrations where a judgment is required, there might be a numerous number of questions coming to your mind as well. So as I can again emphasize, judgment. And judgment is something which could differ from a person to person. And I think we might need sometimes more facts in order to reach a very conclusive decision. Okay, the first parameter which one would take into account is representation on the board of directors or equivalent governing body of the investee. So we can say that even if you've got less than 20% voting power in a company, but you've got as an investor representation on the board of directors, it could be indicative. Mind the words, I'm not saying it will be, I'm saying it could be indicative that you get a significant influence over the investee. Let's, I think, have a look at the illustration number 2. It says Cuckoo has got a 12% voting shares in Boho, and Boho is comprising of 8 members, and 2 of these members are appointed by Cuckoo. So you can say that the investor has got a representation on the board of director. Now, each board member has got one vote at the meeting. Is Boho an associate of Cuckoo? Now, I think if I read the answer, Boho is an associate of Cuckoo as a significant influence is demonstrated by the presence of the presence on the board of directors. It is presumed that significant influence where it holds 20% of the voting power, but not necessary to have a 20% representation on the board of directors. Now, before you start coming to the input, okay, out of 8 directors, 2 directors are going to be appointed. So 2 out of 8 means you got a 25% representation on the board of directors. It very clearly tells you that, it is not necessary that you get the same percentage on the board of directors representation. It all depends upon the facts and circumstances. So one board member may present a significant influence even if the board member has got less than 20% voting power. But we need to look into more specific facts and circumstances. So we're not saying that, representation on the board of directors with a 20% less implies significant influence. We need to assess that as well. But we are saying, yes, with a less than 20% stake with a representation on board of directors could be a possibility of indicating a significant influence. Then there is a second parameter which is given. Participation in a policy-making process. including participations in decisions about dividends or other distributions. So as an investor, if you are involved in the policy-making process, then we can say there is a possibility that you get a significant influence. Let's have a look at illustration number 3. It says M is got a 10% voting power of the investee, and the balance 90% is held by 9 other investors, each having a 10% stake. The decisions about relevant activities, except decisions about taking borrowings of the investee, are taken by the members holding majority voting power. The decisions about taking borrowings are required to be taken by the unanimous consent of all the investors. And let me tell you that taking decisions about the borrowings is supposed to be one of the relevant activities in the company. The presence of the quantum of debt cannot be decided without a unanimous consent of all the investors. So it's a very important decision as well. Further, decisions about taking borrowings are not the decisions that most significantly affects the returns of the investee. So it's not that we are saying that this is the very important decision, but yes, it is certainly important. Determine whether M gets a significant influence over the investee. In this case, M has got less than 20% voting power of the investee. M's consent is required to take decisions about taking borrowings, which is one of the relevant activities. As I just said, that taking decisions on borrowings is supposed to be a relevant activity. Further, since the decisions are not the decisions that most significantly affect, it cannot be said that all investors have got a joint control. Because if you say that this is supposed to be the most significantly affecting the returns, then in that case, we would have landed up saying that there is a joint control. So considering that there is a participation in taking a decision, we can say that there is a possibility that, there could be a significant influence. So what is important is the word participation. So the first one was a representation on the board of directors. The second is the participation in the decision. It is not necessary that you should be able to take a decision, because when you're in a position to take decisions independently, you got to control. And when you're in a position to take decisions along with others, then it can be a joint control. So here you've got a participation, you've got a say. So that is the second parameter. Then there is a third parameter as well. I think a question might also be arising in the mind, sir, are we going to get questions in exams where we are made to assess the significant influence? Well, I think so far, if you look at the examination trend, there have not been questions where you are required to make an assessment of a significant influence. The more emphasis is more on the accounting, but I think still we need to understand how a significant influence is assessed. Then the third one is material transaction. The word is very clear, material. It's not that there are transactions between the investor and the investee. What is important is that these transactions are material in nature. Now, what is material or immaterial is again a matter of judgment, and you cannot draw a line between them. But let's have a look at illustration number 4. It says RS is an entity engaged in the business of pharmaceutical. It is invested in the share capital of XY, and it has got a 15% voting power, less than 20. It says XY is engaged in the business of producing packing for pharmaceutical entity. One of the incentives for RS is to invest in XY was the fact that XY is engaged in the business of producing packing material, which is also useful for RS. Since last many years, the company XYZ has almost taken 90% output from RS. So you can say that indirectly is acting as a supplier. You've got a huge dependency on the associate company because you've got a very important transaction with them. 90% of their output is being procured by the investor. So does the RS company get a significant influence? We can say since 90% output is procured by RS, XY would be dependent on RS for the continuation of its business. Hence, even though RS has got only 15% stake, the presence of significant influence could be there. So material transactions is another parameter. So I think we've done 3 parameters so far. Representation on the board of director is 1. Then we said material transactions between the investor and the investee, that's 2. And then participation in the policy making decisions, participation in the policy process is important. Then number D, interchange of managerial person. It says in illustration number 5, X and Y operate in the same industry, but in different geographical regions. Entity X acquires a 10% stake in Y as a part of the strategic agreement. A new production process is the key to serve a fundamental change in the strategic direction of entity Y. The terms of the agreement provide for Y to start a new production process under the supervision of 2 managers from entity X. Interchange of managerial person. The managers seconded from entity X, one of whom is on the board of X, will oversee the selection and the recruitment of the new staff, the purchase of the new equipment, the training of the workforce, and the negotiation of the new purchase contracts for raw material. The 2 managers which have been seconded in entity Y will report directly to Y's board as well as to entity X. So this is an interchange of the management person. So the secondment of the board member and a senior manager from entity X to Y gives entity X a range of power over the new production process and the evidence that X may have a significant influence over Y. The assessment takes into account what are the key financial operating policies of Y, and therefore we can say he indirectly gets decisions to participate in the financial and operating policies of the company, indicating a significant influence. Wow. And finally, we've got another condition, the 5th condition, and that is a provision of essential technical information. Now, it says in illustration number 6, R is a tire manufacturing entity. The entity is entered into a technology transfer agreement with another entity, Y, which is also involved in the business of tire manufacturing. R is an established entity in this business, whereas Y is relatively a new entity. As per the agreement, R is granted to Y a license to use its technical information and know-how which are related to the processes for manufacture of tires. So you are providing certain essential information to the investee. Y is dependent upon the technical information and the know-how supplied by R because of the lack of expertise and experience in the business. R has made an investment of 10% in the equity share capital of Y. Would R get a significant influence over Y? Yes. In this case, Y obtains certain essential technical, the word is essential technical information for running the business. Hence, R can get a significant influence in spite of a 10% stake in the share capital of the company Y. So, moral of the story, I think, let me just come back to it. So we can see that in all these total 6 illustrations, we've seen the very first illustration was devoted to the first exception, that you've got more than a 20% stake in the company, but it seems to be more like a paper percentage, where you do not have any participation in the operating and financial policy decisions of the company. The other 5 illustrations were devoted to the fact where you've got a percentage below 20%, but due to the fact of any of the 5 parameters, as we saw, that there could be essential technical information, there could be a participation in the policy making process, there could be a representation on the board of directors, and the other parameters like we saw, interchange of managerial, personal, or material transactions between the investor-investee, it could indicate that yes, investor possibly could have a significant influence. I think let's make some notes now at this particular stage. But my first section of this standard is done, the assessment of a significant influence. I hope, friends, we made ourselves very clear on this. Okay, I think Shailendra, you said the video is not available. Are you still not able to get this? Okay, let me just, I think, now make a few notes to you on the first section of the standard, so you can start noting it down. So this is my section number 1. Where we're looking at the assessment, of significant influence. So I'm just going to make some quick notes to you, because this area may not be very relevant from the examination point of view, because it could involve judgment. But we can say that there is a rebuttable presumption I've already explained what is rebuttable in nature, that what is a rebuttable presumption. Okay, all okay out here? Okay, wonderful indeed. So there is a rebuttable presumption. I've already explained what is rebuttable, something which can be challenged. So there is a rebuttable presumption. So we can say that if you've got 20% or more voting power, I'm putting it as VP, if you've got 20% of voting power, we can say it implies a significant influence. And if it is below 20%, it means no significant influence. But we've already said that this can be challenged as well. So I think let's put it this way, that however, we can say, however, it may not be the case. However, it may not be the case. So there is a possibility that you could challenge this. And I think just to make a reference on this, so we can say in this particular case, 20% or more, you can refer to the exception. And that exception is in terms of illustration number 1. And below 20%, you can refer to the illustrations, but I'll give you a list of those exceptions. So you can refer to the exceptions. And the exceptions which are given is illustration number 2 to illustration number 6 of the study mat, just giving you a drawing reference. And I think if you look at the parameters which you need to take into account, so there are certain crucial words which you need to consider. So there are a total of 5 factors which are given. The first one is representation. The first one is representation in board of director. But just to remind you that the percentage on the board of directors need not necessarily be 20%. And then we said there is, let's say, participation. The key word is participation. So there is a participation in policy making. So you've got a participation in policy making that is important. Then it could be interchange. It could be interchange of managerial personnel. Interchange of managerial personnel. And then there could be essential technical information. Essential technical information. So we've got certain essential technical information. So we're providing some essential. The key word is essential. So you can see in each of these parameters, there is a keyword: participation, representation, essential technical information. And then there was another parameter as well. And this is material. The keyword is material transactions. So material transactions are there between the investor as well as the investee. So these are the 5 parameters which could indicate otherwise. Okay. So far, so good. I think we just made a base on the standard. So I think now, before I take it further, because now this journey is going to become a slightly technical. I think so far it's not been very technical indeed. I have just given you some very basic input. So let me just quickly consolidate a few things to you as we take it further, so that you know these things are very well embedded in your minds. So I think just let me do a quick consolidation on this concept with you. Well, I think I've given you 2 important emphases so far since morning, and I'll just like to give you that emphasis back again. You know, the most important aspect what we've understood is that when does Index 28 get triggered? So we can say Index 28 could get triggered typically under 2 circumstances, though I gave you a third case as well, but I think typically it gets triggered under 2 circumstances. As an investor, you've got a significant influence, or let's say you and along with other investors have got a joint control, and that arrangement gets qualified as a joint venture. So you exit out of Index 111 and you come under the purview of Index 28. So as an investor, you've got a joint control with other investors, and it is classified as a joint venture, not a JO, but a joint venture. You come under the purview of Ind AS 28, or you are directly having a significant influence. That's one important thing which I give you. Another important thing which I give you is that when you're making an assessment of a significant influence, you may have a direct or indirect percentage. And when you say it is an indirect percentage, I think the most important thing what you need to keep in mind is that that indirect percentage has to be through a subsidiary. So as an investor, you may directly get a percentage in the company, or you may indirectly hold it through a subsidiary. If you've got indirect investment through another associate or through another joint venture, it doesn't qualify for the assessment of significant influence. Your assessment of significant influence is purely based on a direct percentage, and the focus is indirectly through a subsidiary. That is the focus number 2, which I gave you. And then the third focus which I've given you so far is that significant influence assessment is on the very offset, on the very onset, it seems to be a rule-based assessment. We generally go with a presumption, but which is something rebuttable in nature, that if you get 20% or more, it implies a significant influence and otherwise not. But it can be challenged. You need to look at the facts and circumstances based on judgment and then decide maybe there is a significant influence or not. So typically, if you've got less than 20% stake in a company, then there could be certain 5 essential parameters which could indicate the presence of a significant influence: your representation on the board of directors, the provision of technical information, providing essential technical information, material transactions between investor-investee, interchange of managerial personnel, participation in the policy process. All that could be indicative that significant influence might be there. So 3 major focus points. When does the standard get triggered? The assessment should consider indirect percentage only through a subsidiary, and the rebuttable presumption. I think so far so good. Okay, are you ready now to take something technical with you? Yes, why not? Now, before we come to the accounting aspect, I have a second area of discussion with you, which is relating to exemptions and exceptions. Before that, I think I want to ask you 2 questions based on your understanding on the control assessment in Ind AS 110. So let me, I think, remind you something, because before I take you to the journey where Ind AS 28 tells a company that you're exempted from doing any consolidation under equity method, let me just remind you something. I am just going to Ind AS 110 for the time being. I'm just taking you to Ind AS 110, which was based on a control assessment. Now, you would remember that there were 2 cases where a company which is a parent company, but it is not required to consolidate. So let me, I think, give you 2 situations, and you're going to decide that is it supposed to be optional, or is it supposed to be a case of, you can say, mandate. Okay, let's say, for example, there is a company A which has got a control over B, and B has got a control over C. So A has got a control over B, and B's got a control over C. So it's a kind of a chain holding. It's a kind of a chain holding where A's got a control over B and B's got a control over C. Now, my question is, if you remember, you would remember that in terms of Ind AS 110, which is para number 4 to my mind, there are a total of 4 conditions, which if B Limited is able to fulfill, then B is supposed to be given, and you can say not to make consolidated financial statements. I'm just trying to avoid, giving you the exact language. So the 4 conditions, if you remember, is that number 1, you need to prove that is B a 100% subsidiary of A, or even if it is a partly owned subsidiary of A, and you get a NOC, a no objection certificate from the other investors, that they don't have any objection, they have been informed, and they do not object to B not making a consolidated financial statements. So either B is a wholly owned subsidiary of A, or a B is a partly owned subsidiary of A, but then the other investors are informed and they do not object. That's one condition. B is not a listed company, and B is neither a potentially listed company. It is not in the process of getting listed as well. And the ultimate parent, in this example, A, is making a consolidated financial statements in accordance with Ind AS for public use. In those particular cases, when these four conditions are met, we say, okay, B may not make a consolidated financial statements. Now, let me ask you, friends, something. You know, when B meets these four conditions, is it something which is a choice for B, or is it something which is a mandate for B? The question is very clear. When B fulfills these four conditions, is it a matter of choice for B, or is it a matter of compulsion that he cannot make a consolidated financial statements? Let's, I think, ask you that. And that's very rightly said, Koshki. Wonderful indeed. It is a pure option. It is a pure choice for the company. Very good. It is purely optional for company B that it may or may not do this. And I think if you remember rightly what I said at the start of the lecture, that this is a case what we call exemption. This is a case what we call exemption, where you are telling B Limited that you've got a choice, you are exempted. But if B wants to make a consolidated financial statements, we'll not stop that company. But we're giving them a pure choice, a complete option that you can or you may not, your choice. Let's take another example with you and let's get the status. Let us say there is a company A and that has got a control over B. There is no chain holding. There is no chain holding. A is supposed to be an investment entity. And B, let's say, is also an investment entity, or maybe a non-investment entity, where the activities of B are similar to A. So it could be a case of B being an investment entity, or B is a non-investment entity, but the activities of B are similar to A. Now, in this particular case, is BA required to make a consolidated financial statement? Is it mandatory, or is it a matter of choice for A? A is an investment entity, has got a control over B, which is also an investment entity. So in this particular case, what do you say? Is it a matter of choice, or is it a matter of a mandate for A that he cannot make a consolidated financial statements? Your inputs. It's not a chain holding. I'm not looking at the pattern number 4. This is a case of an investment entity. Now, in this particular case, what do you say? Does the company get a choice, or is it a matter of option? Waiting for your inputs on that. And that's right, Shobham, absolutely. That's right, Koshki. That's right. Wonderful indeed. Now, this is a case which is mandatory. This is mandatory, where we tell A boss, you cannot. So this is mandatory. So this is what we call a case of exception. So I hope I made myself very clear. You know, when earlier I said the case of exemptions and the case of exceptions, I think you would have made it very clear that when a company is given a choice, it is exemption. And when a company is mandated and said, boss, you cannot make a consolidated financial statements, in that particular case, it becomes an exception. Okay, now I think what we're going to do, we're going to work on Ind AS 28, and why I reminded you the parameters in terms of Ind AS 110, because many of these parameters are quite similar what is given in the standard in Ind AS 28 as well. So let me do one thing now. Let me just come back to the study material. And I'm now going to take you to those exceptions where things are there. Okay, now before that, something very interesting. Something very interesting. Before I think we close our section number 1, I think there is something very interesting indeed. And I think this is also one of the very beautiful illustrations devoted in the study material on this particular area. Now let's take a case that A, there is a company A, and this company A is, let's say, got a 40% voting power in terms of B, and it has got a 20% potential voting rights in this company. So let's consider that company A has got a 40% actual voting power by way of equity shares, and it has got 20% potential voting power. Now, my question, friends, to you in this particular case is very simple and straight. Considering that this potential voting power is something which is deeply in money, it is something which is deeply in money. We know that, yes, it will be exercised. Then you know that as per Ind-AS 110, I would say, yes, the control is present in this particular case. Considering that you've got a 40% actual voting power and you've got a 20% potential voting power, and that particular contracts are something which is deeply in money, so there are very good chances that you would exercise those potential voting rights. But now something very interesting. Sometimes we can say that these potential voting rights may not be exercised due to the inability, let's say due to the inability of A to exercise. A may have financial constraints. A may have financial constraints where A would say that even though I've got 20% potential voting rights, but he says I will not be able to exercise these rights because I've got inability to pay. The question rises that the inability of A to exercise these potential voting rights because of the financial constraint, should that be taken for the control assessment? Should that be taken for the significant influence assessment or not? So there is a wonderful illustration devoted to this area, and that is illustration number 7. I think I'll explain the distinction in terms of Ind-AS 110 and Ind-AS 28 with the help of this illustration. It says an entity which has got currently 10% voting power of an entity has an option to purchase additional 15% voting power of the investee from other investor. Now, if you know that this particular investor is got a 10% stake and he would also be able to acquire another 15% stake, he would get a 25% voting power in the investee. It says, however, the entity currently does not have the financial ability to purchase 15% voting power. It says the investor does not have the ability, he does not have enough financial ability to purchase that 15% voting power. Do we still consider whether the entity has got a significant influence or not? And the answer is yes. See what the answer reads. Considering the potential voting rights, the entity can get more than 20% voting power, and hence it is presumed that a significant influence is present over the investee. The fact that the entity does not have a financial ability to purchase such additional voting power is not considered in such assessment. And in the bracket, it says it should be noted that under Ind-AS 110, potential voting rights which cannot be exercised because of the financial liability are not considered to be substantive, and they're not factored in the assessment. However, under Ind-AS 28, there is no such requirement. Hence, the potential voting rights, even if they're not substantive, are included in the calculation of the significant influence. So, moral of the story. Moral of the story, that if you've got 20% potential voting power, if you've got 20% potential voting power, the question arises, are you making an assessment of control under Ind-AS 110? Or are you making a significant influence assessment under Ind-AS 28? Mind the words carefully. Are you making an assessment of control under Ind-AS 110? Or are you making a significant influence assessment under Ind-AS 28? If you're making a control assessment, you need to see the inability to exercise, the financial inability. So if you say there is an inability, I will say control does not exist. But if you say there is an inability, I would say significant influence is present. So if it is exercisable under Ind-AS 28, so I know that I have got certain rights and they are exercisable in nature, even if there is a financial inability to pay, does not make a difference. But it makes a difference when you do a control assessment. So potential voting rights in terms of Ind-AS 110 also need to be substantive in nature, that they can be exercised. The investor would be in a position to exercise those rights or not. So if there is any financial constraint on the part of the investor, then under Ind AS 110, the control cannot be considered. But not the case under Ind AS 28. So that is a distinction in terms of what is there in 110 and 28. So I think this illustration beautifully captures the concept that if you've got potential voting rights, they need to be substantive for control assessment, but they need not be substantive for the significant influence assessment. Even if you've got inability to exercise them due to financial constraint, doesn't make a difference to my assessment. Wow. So that was a very interesting clarification indeed. Okay. So I think so far we are done with the case number 1. I think now I'm going to focus on the case number 2. So now we're going to go to the section number 2, significant influence assessment, including the potential voting rights is all done. Now we're going to go to the third section, and my third area or second area of discussion is the case of exemptions and exceptions. So we'll go to the case of exemptions. To remind you again, when I'm looking at exemptions, it means area where you get an option. And we're looking at the case of exceptions. We're looking at the case of exceptions. And in this particular case, we are saying it's mandatory. So we're going to see, are there any exceptions or not? I'm not saying that Ind AS 28 has got exemptions or exceptions. We'll see whether they are exemptions and whether they are exceptions. Okay, let me now come back to the study material. And I think I am first going to consider the cases of exceptions and exemptions with you. So let's go to the study material on page number 14.150. Okay, now watch this carefully. Now watch this carefully, and I think I am going to give you something very interesting indeed. I want you to just have a look first of all. We're just going to have a plain vanilla look on certain things, and then I'll take you a little deeper into this. It says an entity need not apply equity method to its investment. When it says entity need not apply, it means a matter of choice. It clearly means an exemption. And you can see that the heading is very clear, exemptions from applying the equity method. We given exemption 1, we given exemption 2, and we given exemption 3. I'm a little, sometimes very fond of remembering para numbers as well. So don't need to remember the para numbers in any case. At least when you quote those para numbers in the exam, don't quote a wrong para number, because you might be deducted for putting a wrong para, but you may not at times be given addition marks for writing a right para. So it's a matter of pure choice. So you need not remember the paras. But there are 3 paras given in the standard, the para number 17, 18, and 19. Now, if you look at the exemption 1, 2, and 3, it is nothing but the para number 17, 18, and 19. So you can see that there are 3 exemptions which are given, and this area gets complete. Wow. Now, let me ask you something. Do you think, friends, looking at this concept of exemption 1, 2, and 3, do you think Ind AS 28 has got any exceptions? When you're looking in terms of exemption 1, exemption 2, and exemption 3, does this mean that there are any exceptions in terms of Ind AS 28, or there are only exemptions, which gives you a matter of choice? I think anybody looking at this would apparently say, so there are only exemptions. There are only situations where we are getting a choice of using equity method or not. There are no cases of exceptions. There can be a case of exceptions as well. You would like to know the case where the exemption turns to an exception? Would you like to know the cases when the exemption will turn into an exception? That's a beautiful area. If you want this, tell me on the chat box that would you like to know the case when the exemption turns into an exception and it becomes a case of mandatory situation? And Shobham tells me, yes, sir. Okay, so I think I'm going to give you that. I thought we will get some more inquisitive questions on that. I think a lot of you would like to know that what is the case when the exemption turns into an exception? And I think people who are watching this class would come to know of this particular beautiful area. But I think first we're going to deal with the cases of exemptions with you. And then I'm going to show you a beautiful case where the exemptions could turn into an exception as well. Okay, we get a yes from Rashmi Koshki as well. Okay. So let me, I think, first go one by one with you, and let's, I think, read what is given in the exemption. So first we're focusing on the apparent inputs only. Okay, it says exemption number 1, as per the paragraph 17 of Ind AS 28, an entity need not apply equity method if the entity is a parent. If the entity is a parent that is exempt from preparing consolidated financial statements by the scope exception in the para number 4A of Ind AS 110, or if all the following apply. Trust me, all these 4 conditions which are given below in the box are nothing, but they are the same conditions which are given in the para number 4 of Ind AS 110. So we can simply say in this particular case that, if I just want to show you the para number 17 on a diagrammatic front, I would put it like this. Let's say, for example, if I'm looking at the first exemption, para number 17, let's say there is a company A Limited, and let's say there is a company B Limited, and let's say there is a company C Limited. Let's say A has got a control over B. And let's also consider that B is also got a control over C. And let's also consider that B is also got, let's say, a significant influence over D. So let's consider diagrammatically a situation like this to understand the para number 17. Now, in this particular case, when I was looking at B Limited, and I was looking at is B required to consolidate C under Ind AS 110. So we decided that B, which is a parent company under Ind AS 110, was able to meet the 4 conditions. Let's say the 4 conditions are met. So B was given an exemption not to consolidate C. Now, Ind AS 28 in terms of para number 17. So we can say in this particular case, here also in terms of D, B gets an exemption. So B would not be required to consolidate C under 110. B will not be required to consolidate D under Ind AS 28. So once you fulfill the 4 conditions of Ind AS 110, then you are not required to consolidate a subsidiary, and you are also not required to consolidate an associate company as well. So B will get an exemption in terms of C, and B will also get an exemption in terms of D. So these 4 conditions will give him a complete exemption. I think this should be pretty clear and simple indeed. So indirectly, you can say that as an investor, when you have a subsidiary and you've got an associate, I'm talking of B in my example. So as an investor, B Limited, you've got an investment in a subsidiary, you've got investment in an associate. So if you qualify for exemption under 110, you automatically qualify for exemption under 28 as well. And it very clearly says that the above conditions are similar to the conditions given in para number 4A, and for all those illustrations you've already covered in Ind AS 110. Now let's go to the exemption number 2. Now this is very interesting. When an investment in an associate or a JV is held by or is held indirectly through an entity. Now look at this very carefully. When an investment is held by or is held indirectly through. Now this through is not that subsidiary, mind you friends. This is not a case of subsidiary. We are saying that if you are, it says when an investment is held by an entity which is a venture capital organization, a mutual fund, a unit trust and similar entity, the entity may elect to measure the investment in those associates and joint ventures at FVTPL, fair value through profit and loss, in accordance with Ind AS 109. So you may be as an investor, you may be a VCO, a venture capital organization. You may be a mutual fund, or you may be a UT, a unit trust. So as an investor, if you're yourself a VCO or a mutual fund or a unit trust or similar entity, or you hold an investment through a VCO or a mutual fund or unit trust, in those particular cases, you again get a choice. I think let's take an example. So I think let's take a diagrammatic representation, and this is the para number 18. This is the para number 18, which is the exemption number 2. So let's have a diagrammatic look at this one. So there could be two possibilities. Let's say, for example, there is a company A Limited, and the company A Limited has got, in terms of B, a significant influence. And you say A Limited is supposed to be a venture capital organization or a mutual fund or a unit trust or a similar entity. So if A itself is a venture capital organization, a mutual fund, or unit trust, and it has directly got a significant influence over B, you get an option not to consolidate. So A gets a choice. The other situation could be indirectly. So let's say, for example, there is A Limited, and let's say, for example, A Limited has got a control over the company B. What is important is that it has got a control over B. And B is got, let's say, a significant influence over C. And in this particular case, B is supposed to be a venture capital organization or a mutual fund or a unit trust or similar entity. Then A indirectly through B, which is a venture capital organization, mutual fund, unit trust, gets a significant influence over C. A again gets a choice. So there will be two kinds of situations in para number 18. One is a direct case and one is an indirect case. So a direct case is that A itself is a VCO, mutual fund, or a unit trust. And the other case is A through its subsidiary, which is supposed to be a venture capital organization, mutual fund, or unit trust, is got a significant influence in C. So I think if I come back to the para number 18, the exemption number 2, now if you read, it says, when an investment in an associate or a JV is held by or is held indirectly through an entity that is a VCO, MF, or UT in similar entity, the entity may elect to measure the investments at FVTPL. So in the examples which I gave you, A gets a choice. Either he applies an equity method of accounting, or in this particular case, he decides that I am going to measure the investments at FVTPL. Now, there is an example which is given: a mutual fund invested in the equity share capital of certain companies in excess of 20% of the total equity share capital of those entities. Hence, those entities are presumed to be an associate of the mutual fund. In this case, the mutual fund can decide not to apply equity method and instead measure the investments at FVTPL. Now, this example is a case of a direct investment, because the company A is supposed to be a mutual fund, and in this particular case, it has got a significant influence over the companies, and it gets a choice of accounting under equity or FVTPL. Simple and straight. Okay, then let's come to the third exception, which is typically para number 19. Now, there are some few very interesting examples which are given in the education material based on the para number 17, 18, 19. And one of the questions in the education material also, came in one of the revisionary test papers as well. So what I'm going to do after I'm done with these exemptions, I will take you to some very interesting illustrations on these areas which are given in the education material as well. Let's now have a look at the exemption number 3. So before that, let me make it very clear so that, once we go to the para number 19, we are typically very clear. So we can say that para number 17 is talking about a parent company. I think, mind the words carefully, the para number 17 is talking of a parent company. So if there is a situation of a chain holding, so I am very clear in my words, I'm saying if there is a situation of a chain holding, and in this particular case, you can say that B, which is the middle company in the chain, and it gets an exemption under Ind AS 110, by virtue of those 4 conditions, and if B has got another associate as well, so B gets an exemption not only under Ind AS 110, but it also gets an exemption under Ind AS 28. So once you meet the conditions which are given in Ind AS 110 as a parent company, you are not required to consolidate either a subsidiary or even an associate or a JV. That's one. The second is the para number 18, where we are saying that either you are itself a VCO, a mutual fund or unit trust, and you got a direct investment in an associate, or maybe through your subsidiary, and your subsidiary is a venture capital organization, mutual fund or unit trust, then also you get an exemption, a choice in this particular case. Now comes the case of para number 19. Now let's have a look at the para number 19. This is interesting. This is very interesting. Let me first read the third exemption. It says when an entity has an investment in an associate, a portion of which is held indirectly, through a venture capital organization or a mutual fund. So para number 19 would trigger that you've got a direct and indirect investment both. You've got a direct. Para number 18 was talking of a direct or indirect. Mind it carefully. Para number 18, the exemption number 2 was talking of a direct or indirect. The para number 19 is talking of direct plus indirect. I hope I'm very clear. I think let me emphasize this a little more. If somebody were to ask me a distinction in terms of para number 18 and a distinction in terms of para number 19, which is the exemption number 2 in the study and the exemption number 3, I would say, when do you apply the concept of para number 18? Para number 18 is a case when you've got a direct investment. Or para number 18 is a case when you've got indirect investment, either direct or indirect. It is direct or indirect. And para number 19 is a case when you've got direct plus indirect investment both. I hope I am clear on my area. So you've got a direct and indirect investment both. So we can say that in terms of para number 18, you were looking at A Limited, which is a venture capital organization, mutual fund, or a unit trust, has got a significant influence over B, a direct case. Or A through its subsidiary B has got indirect investment in C, and B is supposed to be the VCO mutual fund and all. So it is either direct or indirect. But when you're looking at para number 19, what is important is that A is got investment in B and it has got investment in C. So A is got a direct investment also. And A is also got, you can say, an indirect investment through B. So para number 19 is talking of that if you've got a direct indirect investment, a portion is direct, a portion is indirect in nature. I hope I'm very clear. So when an entity has an investment in an associate, a portion of which is held indirectly through a VCO mutual fund and similar entity, the entity may elect to measure the portion of that investment in the associate at FPTPL. This is regardless of whether the VCO has got a significant influence over that portion or not. If the entity elects that option, the entity shall apply the equity method to any remaining portion of the investment which is not held by the VCO, which means, what is the exemption number 3 indirectly telling me? That for this indirect portion, you have a choice of applying an equity method or FPTPL. And in terms of this direct portion, you don't get a choice. You need to apply an equity method only. And it also clarifies that this choice is available even if B independently in C does not have 20% voting power. You establish a significant influence on the ground that A in C and A through B in C directly, indirectly gets 20%. So significant influence establishment will take a direct, indirect percentage. But when you're giving this exemption to B, When you're giving the exemption in terms of the portion which A indirectly has in C, it doesn't make a difference whether, in this case, B in C independently is a case of below 20% or more than 20%, doesn't make a difference. I think I want to first of all, consolidate this bit a little further. I want to give you the inputs in terms of the para number 17, 18, 19 with a few simple examples. Then I think we can go to the illustration in the study. Then we'll do a little more deeper study into this. So let's consolidate the inputs first of all to you. So let's get very clear on the three exemptions. I'm still yet to discuss on the exception part. So I think let me just, get the inputs. So there is a case of exemption 1. There is a case of exemption 1. The exemption 1 for your reference is para number 17. Maybe you can note it down as well. And the second is the exemption number 2. The second is the case of exemption number 2, which is a case of para number 18. And the third is the case of exemption number 3. The third is the case of exemption number 3, which is the para number 19. So we've got 3 cases, para 17, para 18, and para number 19. Now, I think let's understand this with a small little example so that it gets very clear. Now, we're looking at para number 17 is a case. And I think you would recall that in terms of Index 110, when you're looking at the 4 conditions in para number 4, they cannot apply other than chain holding. Mind the words carefully. When you're looking in terms of Index 110, the 4 cases, the 4 conditions which are there, it cannot be a case other than chain holding. So for para number 17, typically, you will always see a case of a chain holding. Mind the words carefully. You would always see a case of a chain holding. So let's consider a case where we are saying that A gets a control over B, and B gets a control over C, and B gets a significant influence over D. So that is the case. So para number 17 essentially will see that there will be a chain holding. Mind the words carefully. So when you go to see the concept of chain holding, we can say B in this particular case will evaluate the 4 conditions given under Index 110. B will evaluate the 4 conditions which are given in Index 110. And if B is able to meet the 4 conditions of Index 110, does this also mean that he automatically gets an exemption to consolidate D as well? Tell me yes or no. If B, by virtue of Index 110, gets an exemption to consolidate C, does it also mean that B indirectly gets an exemption to consolidate D as well under Index 28? And that's rightly said. Okay, I think Shobham, you've got a question. And I think, Kosh, you want me to put the example number 3 again. No worries. I'm just going to consolidate that. Okay, Shobham, you said in para number 18 example, B has exemption for consolidation, but A also gets an exemption. I'll very shortly come to that. No worry. And Koshki said in para 19, it becomes an exception to A. No, don't conclude so early. Wait. Let's, I think, consolidate this input. So I think let me first come to my para number 17. So would it be technically correct to say that if B under Index 110 meets the 4 conditions of 110, does it necessarily also imply that he would also get an exemption for D under Index 28? Say yes or no. And that's right, he said yes. If you get an exemption to consolidate a subsidiary, you also indirectly get an exemption to consolidate an associate as well. So we can say B gets exemption both under Index 28 as well, because those 4 conditions are same what are given in Index 110. So you're exempted to consolidate a subsidiary, you're exempted to consolidate an associate company as well. Okay, now let's go to the case number 2. That is exemption number 2, para 18. Now watch this carefully. Now, when I'm looking at the case of para number 18, there can be 2 kinds of cases. A has got a significant influence over B. A is a venture capital organization, A is a mutual fund, or A is a unit trust or a similar entity. So if you're able to prove it to me that A, which is the investor, in itself is a VCO or MF or UT, then A gets an exemption. Finish. This is a case where we can say it's a direct investment made by A in B. Now let's take another example, in this case, a second case where it is a case not direct, but it is indirect. So in this particular case, let's say A has got a control over B, A has got a control over B, and B is also got a significant influence over C. And in this case, the subsidiary B is a venture capital organization, or it is a mutual fund, or it is a unit trust or a similar entity. So can I say A is got indirectly an investment in C? A still gets an exemption. So A directly has investment in an associate where A himself is a VCO, etc. Or A through a subsidiary B where the subsidiary is a VCO, etc. A gets an exemption to consolidate C as well. I hope I'm pretty clear on the para number 18 as well. So this is the two cases. The third one now, the exemption number 3, which is para number 19. Now, in terms of para number 19, there is a company A, and let's say A has got investment in C, he's got investment in B, and B's also got investment in C. A's got a 10% stake in B, and A's got a control over B, and B has got another 10% stake in C. So in this case, we are saying B is supposed to be a venture capital organization, etc. So we can say A has got a direct percentage in C, but A is not a VCO. A is not a VCO. So A has got a direct percentage in C. So for this direct percentage of 10%, he has to apply equity method. For this 10% direct percentage, he has to apply equity method. A is got indirectly in C. A is got indirectly in C, where B is a VCO, etc. For this particular portion, which is indirect, he gets a choice. He gets either to apply equity method or FPTPL. Right? I hope I'm clear. So we are saying that A is got 2 percentages, a direct percentage where equity method has to apply. And A has got an indirect percentage through B, which is a venture capital organization, mutual fund, or trust. And in that case, he gets a choice. Am I clear now, friends, on that? I guess your question gets answered on that, I think. Now, I think, Shobham, you said if B gets exemption, then A should also, but that was clear. I think Koshki clear on this. Shobham, you said in para number 18 example, B is exemption for consolidation, but does A also get a consolidation exemption? No. I think if you're looking at the case in para number 18, which is an indirect case, A is supposed to consolidate B and C. A will have to consolidate B and, A gets an exemption. Sorry, my mistake. In the second case of indirect percentages, you can say A is not required to consolidate C. A would consolidate B. But in this particular case, A is getting an exemption to consolidate C in my example. So I think now I've made myself pretty clear on these 3 exemption cases that exemption 1 is typically a case of chain holding. The exemption number 2 on para 18 is a case of a direct or indirect investment. Either you directly get a significant influence or through a subsidiary you get a significant influence. And the para number 3, the exemption number 3 is a blended case of a direct, indirect both. That means you've got a direct share also, you've got an indirect share also. Right? I hope so far so clear. Okay, Shobham, that was my question. Clear now. Okay, wonderful indeed. Now, friends, I think I've given you the entire explanation of these 3 exemptions, but I've still not given you the area in which particular case we can say that A is, let's say in this particular case, the exemption becomes an exception. So what I'm going to do, first of all, I think I'm going to give you a break at the moment. Then I'm going to do some 2, 3 very interesting illustrations which are given in the education material. And that'll give you one of the most beautiful cases when an exemption turns into an exception. With these 3 paras in mind, we're going to do those 3 illustrations with you. So we'll take a 10-12 minutes break, friends, with you, and then we're going to commence back with you. So I think we're going to take a break, friends, and meet you after the break. Enjoy your break. Welcome back, friends. So before the break, we were discussing the three areas of exemptions in terms of where the entity gets a choice of applying Ind AS 28, that is equity method of accounting or not. I think now we're going to take up some few examples, few questions with you. And this will give you a little more clarity in terms of cases which are exemptions and which could be a case of exceptions as well. So I'm going to share a few questions with you on the education material. And one of the questions in the education material is also appeared in one of the revisionary test papers as well. So I think let's start with, first of all, the input to you. So I'm going to take 2-3 questions with you. I think let's start with a little simpler one. Or maybe I think maybe a complicated one. So I have this one particular question. Then there are 2 more questions, I think. Let me first start with the study material illustration, I guess. So let me begin with the question in the study mat. First of all, let's have a look at illustration number 9. It says M&O has got a 15% voting power of DEF. And then it says PQR mutual fund, which is a subsidiary of M&O, is also got a 10% voting power in DEF. So I think let me do one thing. Let me just diagrammatically draw the inputs in terms of this illustration number 9 so that we can have a very clear-cut picture for the same. So I'm looking at the illustration number 9, and we can look at the facts of the case that there is a company M&O. And this company M&O is got a stake in the company DEF. It has got a stake in terms of company DEF, and it has got a 15% voting power. So there is a 15% voting power in DEF. Then we're also given that PQR is a mutual fund company, which is a subsidiary of M&O. So there is a company PQR, and this company PQR is a subsidiary. So M&O has got a control over this particular company. And then it says this company PQR is a mutual fund company, and it has also got a 10% stake in DEF. So it's a mutual fund company, and it has got a 10% stake in this company. Okay, then further we are also given the inputs. It says, hence, M&O has got a 25% voting power, 15%, which is, I would say, direct, and 10%, I would say, is indirect, which is held by a subsidiary. And accordingly, it has got a significant influence. So the assessment has already been done that significant influence is present. So I think you will definitely agree with me that there is a direct percentage and there is an indirect percentage. So you can say there are 2 portions of the investment. Why I'm using the word portion carefully, because this would trigger the thoughts that this is an application of the para number 19. So we can say we have got 2 portions of the investment. So I would say one of the portions of the investment is a direct percentage, which is supposed to be 15%, and one is an indirect percentage, and the indirect percentage is held through a subsidiary, and the subsidiary is a mutual fund. So in this particular case, since it's a direct and indirect, we can definitely say that the exemption number 3, that is the para number 19, would apply. But this exemption is going to be available only to one portion of the investment. So it says that how should M&O account for the investment in DEF in its consolidated financial? So I think before I read out the answer, I think we can very easily decide that for the portion which is 15%, he is supposed to apply the equity method of accounting. Ind AS 28 would apply on a mandatory basis. And for the 10% investment which is held through a subsidiary, which is supposed to be a mutual fund, in this case, he gets a choice. Either the company can choose to apply an equity method, or it can choose to apply FPTPL. That's a pure choice of the company. And the moment it becomes a case of choice, it becomes a case of exemption as well. So I think if you read the answer, that's what is given. 15% interest which is held directly by M&O should be measured as per the equity method of accounting. However, with respect to the 10% interest which is held through a mutual fund, MNO can avail the exemption from applying the equity method to the 10% and instead measure the investment at FPTPL. To summarize, the total interest is divided into two portions. One is a direct portion where you apply equity method, and one is the indirect portion to which you get a choice of FPTPL or equity method of accounting. That's what I've given you. This is a good example in terms of the exemption number 3, which is based on para number 19. I guess that would be fairly simple and clear to you. Okay, the journey technically ends if you start looking at this, and that's absolutely correct. Okay, now I think I want to take it a little further because I want to give you a little more clarity in terms of these para. So I think let's have a look at, first of all, a very interesting illustration, which is now given in the education material. So I am taking you to the question number 5 of the education material. Now watch this very carefully. You get the concept in the next 2 minutes. Now look at the question number 5 in the education material. That following is the group structure of company ABC. Now this company ABC is an investment entity and is also a VCO. Oh my God. Now this company ABC is not only a venture capital organization, but also an investment entity. And the company EB is supposed to be a subsidiary of ABC, and the company PQ is an associate of ABC, and these are non-investment entity. Then it says ABC is a venture capital organizations and fulfills the definition of investment entity under Ind AS 110. How should ABC account for its investment in AB and PQ in the financial statements under 110 and Ind AS 28? Now, hear this very carefully as I give you the inputs. I think let us first of all look at the relationship of company ABC and AB and ask you a question. I'm just looking at ABC's investment in the company AB, which is a subsidiary. Now, let's consider that ABC, which is an investment entity, is able to meet the conditions of not consolidating AB. It meets the conditions of not consolidating AB under Ind AS 110, not in terms of para number 4, but it would be in terms of the status which an investment entity gets, which is based on typically para number 31 to para number 33 of Ind AS 110. So if ABC gets an exemption, rather I would say ABC is supposed to not consolidate AB, is it mandatory or is it something which is optional? I'm talking of 110, which I asked you a couple of minutes back as well. Being an investment entity, what is the status of Ind AS 110? Is it an optional or is it a mandatory case of not consolidating? Is it exception or is it exemption? And I think you can definitely decide on that. Think. An investment entity status would bring it under what purview? So would ABC be given an option not to consolidate AB, or will be told on a mandatory basis that you cannot consolidate company AB? I think that's a very important input. So what do you say? I'm still waiting for your answers on that. So in my example, what do you think? The company AB is mandatorily required not to be consolidated, or you get an option? Okay, I think I should answer that. The company AB will be told, the company ABC will be told that you cannot consolidate AB. It would be a case of a mandatory case where we will say you cannot consolidate. It's not a choice. Now the question arises that if you look at the para number 17, the case of exemption number 1 under Ind AS 28, this subsidiary is being told that you cannot make a consolidated balance sheet. And the same company ABC is told under Ind AS 28 that you got a choice of not consolidating. Either applying FPTPL, you get a choice of not consolidating. So now the question arises, on one hand, he gets a mandatory situation under 110. And the other hand, he gets a choice. So do you think this choice should indirectly turn into a mandatory situation? where company ABC will be told that though under Ind AS 28, you are getting a choice, but since you fall under the mandatory exception under 110, you are also indirectly mandated not to consolidate under Ind AS 28. I hope, friends, I am making sense. I hope I'm making sense. So when a company gets the status of a mandatory exception under 110, then indirectly it should also get a status of mandatory exception under Ind AS 28, where the exemption turns into an exception by virtue of Ind AS 110. I hope I am clear. I hope I am clear with this particular example, friends. If you got anything still further to ask me. So I have given you one thing very clear, that if ABC as a parent company gets a mandatory exception under 110, even though the same company under Ind AS 28 is getting an exemption, but this exemption will be indirectly treated as good as a mandatory exception. So even though it is apparently a matter of choice, but this choice will become mandate, and we will tell ABC, you cannot consolidate AB, you cannot consolidate PQ. We are not giving you a choice, boss, but you cannot consolidate either of the subsidiary or either of the associate company. Am I clear, friends, on that? I hope so. Yes, wonderful indeed. Okay, now I think let's take you to one of the very interesting questions which came in the revisionary test papers as well. And that is the question number 4, which came in one of the RTPs as well. It's in the education material as well. So I think let's draw the diagrammatic view of this. And we are given a total of 3 situations. Let's see. It says entity P has got 2 wholly owned subsidiary X and Y, each of which has got an ownership interest in an associate Z. So I think let's have a diagrammatic view in terms of this particular illustration. So let me just draw the diagrammatic position of the question number 4 of the education material. It's one of the questions which came in the revisionary test papers as well. I guess if I rightly remember, I think it came in 2020, November 2020, I guess. So you can have a look at the RTP of November 2020, where this question from the education material appeared. Let's, I think, read. So the facts of the case are given that entity P is a parent and it has got 2 wholly owned subsidiary X and Y. So there is a company P and it has got 2 wholly owned subsidiary X and Y. There is a 100% stake in X and there is a 100% stake in Y. And then further, he adds on that each of which has got ownership interest in an associate Z. So each of these companies has got a stake in Z as well, and this becomes an associate. We'll see what is the percentages they've got in this case. So this becomes a subsidiary, this becomes a subsidiary, and this becomes an associate. Now let us see what is the case. Further, it says neither of these investments held in Z by subsidiary X and Y is held for trading. Subsidiary X and Y account for investment in associate at FPTPL in accordance with Ind AS 109 and uses the equity method in accordance with Ind AS 28. How should we account for the investment in Z in the following scenario? Now we're given 3 typical scenarios. Number 1. Both the investments result in a significant influence on a standalone basis. X and Y has got a 25% and 20% stake in Z. So we're given scenario number 1 that X has got a 25% stake in Z and Y has got a 20% stake in Z. So they've got 20%, 25% and 20% stake in both sides. Okay, now let's have a look in terms of things. Now we are given something out here. It says earlier that subsidiary X is a VCO. The subsidiary X is supposed to be a venture capital organization. Now I think you would vouch me very carefully on this area. You can see in this particular area, though I said in para number 19 that it's a sum total of direct indirect. I said earlier that in terms of pattern number 19, it is direct, indirect, but you can see it is all indirect in nature. There is no direct percentage. It is all indirect in nature. P indirectly through X and P indirectly through Y is got a stake in Z. It's an indirect percentage, but what is important is that one portion of the indirect percentage is through a VCO and the other percentage is not through a VCO. So we can say this investment has got two portions. There is a portion number one, which is 25%, which is held indirectly through VCO. And there is a portion 20% which is held indirectly, but not through a VCO. So we can say the portion which is held indirectly through a VCO, the portion which is held indirectly through a VCO, in this particular case, you get a choice. In this particular case, you get a choice. And for the other portion, you have to apply Index 28. You need to apply an equity method. And this would apply as is given in the standard, irrespective on a standalone basis. Even if this was below 20, I don't care. Even if this is below 20, I don't care. To the extent a significant influence is established. So if you can establish a significant influence, it doesn't make a difference whether on the left-hand side and on the right-hand side, the individual percentages are below 20% or not, doesn't make a difference to the analysis. Okay, I think if we go to the scenario number 2. So this was scenario number 1. Now let's have a look at the scenario number 2. When neither of these investments result in a significant influence, but do provide the parent with a significant influence on a combined basis, they've got a 10% stake each. So in the second case, we're given that there is a 10% on the left-hand side and there is a 10% on the right-hand side. Would that make any difference to my analysis? No. We can say P has got a 10 plus 10, a 20% stake in Z. So even though individually P through X has got below 20, P through Y has got below 20, it doesn't make a difference to the analysis. The exemption under pattern number 19 will still be available. So to the portion of investment held through X, you get a choice. And for the portion of investments held through Y, you need to mandatorily apply an equity method. Again, just to further clarify, there is a scenario number 3 is given as well. It says one of the investment in the associate results in a significant influence on a standalone basis, and the other investment does not result in a significant influence. So let's say X has got a 30% in Z and Y has got a 10% in this case. So let's say this is the third case. There is a 30% on the left-hand side and there is a 10% on the right-hand side. It doesn't make a difference to my analysis at all. You can say whether on the left-hand side or on the right-hand side, there is significant influence, or there is one side a significant influence and the other side not, or there is no significant influence on either side. It doesn't make a difference to the analysis. So the moment you're able to establish an overall significant influence, irrespective that on the two portions, which is through VCO or not through VCO, we get the same status. So whatever portion is held through the VCO, whether the percentage is more than 20, less than 20, doesn't make a difference. You get a choice. For the portion which is held indirectly without a VCO, you need to apply an equity method. So this was a very interesting clarification, which is given in the education material and one of the questions in the RTP as well. Okay, now I think I want to consolidate the moral of the story. So I'm now going to consolidate the moral of the story. Now I think you can vouch me and start writing some notes as well. My second area of discussion is done. Out of the 5 focus areas which I gave you, the 2 areas are done. Now let me just consolidate the picture. So I think I'm now going to give you situations and you're going to vouch me. Though we've written para 17, 18, 19, I'm just going to give you situations and you're going to vouch me on this. Decide if you can decide it is a case of exemption or if it is a case of exception. Okay, let's begin the journey. I'm giving you the first case. A has got a control over B. A has got a control over B. And B is, let's say, got a control over C. And we are saying that He's also got a significant influence over D. Now, let me ask you a few questions, friends. Think carefully as you answer. Can I say in this particular case, B applies index 110. And the four conditions given in the para number 4 are met. B applies index 110 and the four conditions are met. Can I say, does this automatically mean that B under ind AS 28, B under ind AS 28 will also get an exemption for D as well? He gets an exemption to consolidate C. So by default, you can say he gets an exemption to consolidate D as well. Is that right to say? Is that right to say that if B gets an exemption under 110, by default, it gets an exemption under Index 28 as well? And I think if you agree, this is a clear-cut case of para number 17. That when a company gets an exemption under 110, you can say by default, it also gets an exemption under Index 28. That is the para number 17. Great. Now, let's go to the second case. Let's go to the second case with you. Now, let's consider in this particular case, we've got company A Limited. We've got a company A Limited in this particular case, and A Limited is supposed to be a venture capital organization or a mutual fund or a unit trust. And there is a company B. So I'm looking at 2A. I'm looking at 2A. Now, in this particular case, let's say, for example, A has got a venture capital organization and it has got a significant influence over B. Can I say in this particular case, A has got a direct investment in B? If A has got a direct investment in B and it is in itself a VCO, a mutual fund or unit trust, he again gets an exemption. He again gets an exemption. And if I tell you, this is the para number 18, where you're saying that you've got directly a stake in an associate company and you are an investor, which is a VCO, mutual fund or unit trust. I think you'll agree with that. Let's go to the 2B. 2B is also a case of para number 18, and we're looking at A Limited. We're looking at A Limited, and we're looking at A Limited, and then there is B Limited, and then there is C Limited. So A Limited has got a control over B Limited, and B Limited has got a significant influence over C Limited. And B Limited is supposed to be a venture capital organization or a mutual fund or a unit trust. Now, friends, very carefully. Can I say in this particular case, it is a case of indirect holding A through a subsidiary, where the subsidiary is a venture capital mutual fund, has got a significant influence over C. Can I say again, A gets an exemption in this particular case? A again gets an exemption in this particular case by virtue of para number 18. So this 2A is direct and this 2B is supposed to be indirect. So we can say this is direct in nature and we can say this is indirect in nature. Now let's give you another variation in terms of 2C. Let's give you another variation in terms of 2C. So let me take another situation that is 2C. Now, let's say there is a company A Limited and let's say there is a company B Limited. Let's say there is a company B Limited and let's say there is a company C Limited. Now, in this particular case, let's say A is supposed to be an investment entity and B is supposed to be a venture capital organization, or you can say, in this case, a mutual fund or a unit trust. So in this particular case, we are looking at that A in this particular case, or rather, let's take this C not out here. Let's take it out here. So let's take it out here. Let's take company C Limited. And this is also an investment entity. There is a control and there is a significant influence. I think that would be similar to the education material. Now, the question comes to the mind in this particular case. Okay, this is not a VCO. I think let's change that. This is an investment entity as well as a VCO as well. So we're looking at A has got a control over C and A has got a significant influence over B. Now, let me ask you something which you can vouch me very carefully in this particular case. Can I say in terms of C, is it exemption or exception? Can I say in terms of Ind AS 110, it becomes a case of exception. It's not a case of exemption. We will tell this company, you cannot consolidate under Ind AS 110. Now, let me ask you independently in terms of B, is it a case of exemption or a case of exception? Apparently, it is a case of exemption. But I think if you read both of them, put together, then this exemption will turn into exception. This exemption will indirectly turn into exception. So this is the case which I was talking early part of the class, that where an exemption will convert into an exception. So you can say as an investor, you are a parent and you are investment entity in a VCO both. If you're an investment entity in a VCO both, on one hand, as a parent, you get a mandatory exception. And on the other hand, under Ind AS 28, you get an optional exemption. But in this case, since there will be a contradiction in terms of Ind AS 110 and in terms of Ind AS 28, we will treat this exemption as good as exception. So A will not be able to consolidate B also. A will not be able to consolidate C also. I hope my situation number 2C is pretty much clear indeed. Okay, that's wonderful indeed. That's rightly said, Koshki. Wonderful. Now let's go to the situation number 3. So now let's have a look at a situation number 3, which is typically based on, you can say, the para number 19, which is based on the para number 19 on a very apparent front. We've got A, and it has got a stake in B, and it has got a stake in C, and C has got a stake in B. So it could be indirect, it could be direct, indirect, but what is important for para number 19 is that it is either direct plus indirect, or it can be simply indirect plus indirect. It can be indirect plus indirect, but one of the indirect portions. What is important is it can be direct, indirect, or it can be indirect, indirect, but what is important is one portion of the indirect should be through a VCO or a mutual fund or a unit trust. A portion which is indirect has to be through a company which is a VCO. So let's say E in B has got a 10% stake, and E in C has got a control, and in this particular case, it's got another person's stake, and C is a venture capital organization or a mutual fund or a unit trust. So there is a direct percentage on which you need to apply an equity method, no exemption. And then there is another portion which is indirect. Here you get a choice, and it again becomes a case of exemption. So we can say for the para number 19, if you've got only direct, it cannot be a case of para 19. So para 19 would apply when it is either direct plus indirect, but the indirect should be through VCO, or it is indirect, but whatever one portion of the indirect should be through VCO. Like in the education material, the both portions were indirect, but one was without VCO and the other indirect was with a VCO. Okay, I think that's fair enough. I think you would have got your entire PhD done in terms of the exemptions and the exceptions in terms of the equity method. Okay, so I hope everybody is pretty much clear on our discussion so far on this area, I guess. Clear? Wonderful indeed. Okay, now I am going to go to the third area of discussion with you. So since morning, what I've done, I have covered the aspect of two things with you. The assessment of a significant influence, which is not typically a rule-based accounting, rule-based assessment, but largely a principle-based assessment. We've seen those exceptions. The second, we have seen the three cases which are apparently exemptions, and when can an exemption turn out into an exception. Now we're going to go to the third area of discussion with you, which is an application of what we call equity method of accounting. So this is my third area. And that is what is called the accounting. And the accounting is done with the help of what you call equity method of accounting. Now, this is very simple, and I'll explain this with a very simple little example to you. And there is a very basic illustration, not a basic, but I think a very comfortable illustration given in the study mat, which gives you an idea on the equity method. So let me first of all take my own example, a basic example, to explain the concept of equity method. But first of all, let me tell you that this equity method is also called a one-line consolidation. It is also called a one-line consolidation technique. Because unlike the consolidation technique, which is used in Ind AS 110, it's a line-by-line addition. You aggregate the assets, you aggregate the liabilities on a line-to-line basis, but in this case, it's a one-line consolidation because only the investment is consolidated. We don't aggregate the assets and liability of the investor and the associate company. So let's take a very simple example to understand this bit. Let's consider that there is a company A, and let's say the company A has got a significant influence over B with a 25% voting power. And let's say A company acquired a significant influence over B, and let's say that was acquired at a cost of, let's say, 30 lakh. So let's say E get a significant influence over B, and let's say acquired at 30 lakhs. Now on that particular date, let's say the net assets of B at a fair value, not book value. So on that particular date of acquisition, let's say the net assets of B at a fair value is, let's say, equal to, let's say, 100 lakhs. So what we're going to do, we're going to do the similar kind of comparison, which we do in terms of calculating a goodwill or capital reserve. So we're going to compare the two things. What we're going to do, we're going to compare that you paid 30 lakhs as a consideration to get a significant influence over the company. And in return, what do you get? You get out of this net assets of 100 lakh a 25% stake. So your share in the net assets at a fair value is 25%. So you paid a premium, which is to the extent of 5 lakh, and that premium paid is called a goodwill. Now, let me first of all make one input very clear, that this goodwill which you have identified at the date of acquisition is not going to appear as a separate item in the balance sheet. It's not going to appear separately in the balance sheet, but it is going to appear as a part of the carrying value of the investment. Which means, hear this very carefully, let's say this is the financial statements, let's say this is the separate financial statements of the investor. And let's say this is the consolidated financial statements of the investor. So let's say you're making the separate financial statements of A, and let's say you're making a consolidated financial statements of A. Now, when you're making these separate financial statements of A, in this particular case, you're following Ind AS 27. And when you're preparing the consolidated financial statements of A, you're following Ind AS 28, where you need to show this investment using an equity method. But if I were to show you the positions on the date of acquisitions, mind you, if I were to show the positions on the date of acquisition, what is the cost of the investment? The investment would appear at a cost of 30 lakhs in the separate financial statements on the date of acquisition. And interestingly, even in the consolidated financial statements, the investment would appear at 30 lakhs itself on the date of acquisition. On the date of acquisition, the investment value in the separate and the consolidated financials will be same, except that you're going to give a disclosure that this is including a goodwill to the extent of 5 lakhs as a part of the carrying value. So the goodwill which is computed is not shown as a separate line item, but it is included as a part of the carrying value of the investment. So we will be telling these stakeholders that this investment of 30 lakh is nothing, but it is including a goodwill of 25 lakh, which indirectly means that you're representing the investment at the share in the net assets plus the amount of goodwill. Indirectly, for our understanding, we can say the investment is going to appear at the share in the net assets on that date, which is 25 lakhs plus the amount of goodwill. This is how the status would appear on the date of acquisition. But as we're going to subsequently proceed at a later dates, When we're going to make our consolidated financial statements 1 year or 2 years later, then the position in the separate and the consolidated financials will change. The position in the separate financials, now hear me very carefully. I'm giving a little insight on the Ind AS 27. Now, subsequently, you can say in this particular case, this investment will continue at 30 lakhs itself unless there is impairment. So this will continue to be 30 lakhs itself unless there is going to be an impairment in terms of IAS 36. In this particular case, if there has been an impairment under IAS 36, otherwise the investment in the separate financials will continue at 30 lakh. Because when you record the investment at cost, though let me tell you that this is a financial asset, but this investment is not covered under Ind AS 109. You've already seen in financial instrument standard that investment in an associate, subsidiary, or a JV is not a financial asset accounted under 109, but they're accounted under Ind AS 27. And since they're not covered under Ind AS 109, though it's a financial asset, the impairment testing doesn't take place under Ind AS 109, but the impairment testing takes place under Ind AS 36. That you've already learned when you did the concept of impairment testing under 109. So this 30 lakhs is going to be subject to the impairment testing. Now, what happens in this particular case? When you're making a consolidated financial statements, now here you need to apply what you call an equity method. And trust me, the equity method is very simple to apply. You know, I always apply this equity method considering the hand in two positions. I remember, you know, when you must have been in CA Foundation, you must have learned the art of a bank reconciliation statement with the help of these two hands. We're used to consider one of the hands as a cash book and the other as a passbook. Then I think in the CA Intermediate, when you were doing the chapter in cost accounting on reconciliation of cost and financial accounts, you used to again use the two hands and decide that one is a costing hand and one is a financial hand, and used to decide a reconciliation statement. Trust me, now in CA Final, if you want to understand the essence in terms of Ind AS 28, you can again use the two hands. But this time, what are the two hands going to be? One of the hands is going to represent the equity or the net assets of the associate. And the other hand is going to represent the investment in the books of the investor. So you need to consider a very simple accounting. See what you're going to do. You're going to consider your two hands like this. This is the, you can say, equity, or you can say the net assets of the associate company. And this is the investment in the books of the investor on the other hand. Now you need to apply a very simple logic. If the equity of the associate increases, you need to increase the investment value. So if the equity increases, you need to debit the investment and increase it. But the question arises, what's going to be the corresponding credit? Because if the equity of the associate company goes up, then the investment value also goes up. But remember, the investment value will increase, you can say, only to the extent of share in that increase, not the entire. So let's say if the equity of the associate company, let's say, increases by 40 lakhs, considering that I've got a 25% stake in the company, my investment will increase by 25%, that is 10 lakh. So you need to visualize for every transaction post-acquisition date. This is the accounting which we are going to apply. This concept is what we're going to apply post-acquisition. That you need to just see the movements in terms of equity of the associate. If the associate equity moves up, then calculate your share in that increase and increase debit the investment. But then the question rises, what is going to be the corresponding credit which you're going to record in the books of accounts? And I think, let me say something point blank to you. You will give a corresponding credit based on what the associate did. If the associate company gave a credit to the P&L, you give a credit to the P&L. If the associate company gave a credit to the OCI, you give a credit to the OCI as an investor. If the associate company gives a credit to the equity, that is to the SOKI, you need to give a credit to the SOKI directly. So which means the corresponding credit all depends upon the movement in the books of the associate. If the associate company has a credit in the P&L, the investor will also give a credit in the P&L. If the associate company says that there is a credit in the OCI, then the investor would also give a credit to the OCI. If the associate company is given a credit directly in SOKI, then the associate, the investor would also give a direct credit to the equity. So can you take examples for that? Okay, let's give you an example for that. Let's say in the post-acquisition period, that means after the date of acquisition, the associate company earned a profit in the profit and loss section, that is 20 lakhs. And let us say they earned a profit in the other comprehensive income section, let's say that is to the extent of 10 lakh. So they got a total increase of profit to the extent of 30 lakh. So the associate company in a post-acquisition period earned a profit of total comprehensive income of 30 lakh, comprising of 20 lakhs computed in the profit and loss section of the income statement, and 10 lakh is earned in the other comprehensive income section. So what would the parent company now do? He would put the entry investment will be given a debit, because earning profits would mean that the associate equity is gone up. And if the associate equity is gone up, then I will take, let's say, 25% stake. So we will debit the investment by 5 lakhs, and the corresponding credit will be given to the profit and loss account to the extent of 5 lakh. So its share in this 5 lakhs. The associate gave a credit to the P&L, the parent, the investor also gave a credit to the P&L. Then the investor would do the entry, investment will be given a debit. So out of the 10 lakh, if you've got a 25% stake, so you debit the investment by 2.5. But where is the corresponding credit going to be taken? The corresponding credit is going to be taken to the other comprehensive income. The associate company in this particular case gave a credit to the OCI, so you also need to give a credit to the OCI. So the equity method of accounting has got a very simple basis of accounting. All you need to see is, number one, the impact on the equity. And all you need to see is that what is the corresponding credit given by the associate company. So these two will decide the fate of accounting in the books of the, you can say, investor. So you just need to visualize that due to a particular transaction in a post-acquisition period, if the equity increases, investment debit. Equity decreases, investment credit, but to the extent of the share in that increase or decrease as the case might be. And the corresponding credits will be given accordingly. Whatever the associate credits, the parent credits the same. The associate gives a credit to the P&L, you give a credit to the P&L. It gives a credit to the OCI, you give a credit to the OCI. It gives a credit to the equity. Then in that case, you give a credit to the equity. So same logic would apply, as I said, if there is any transaction which is going to result in decrease in the equity, you need to decrease the investment. In this particular case, the investments will be given a credit. So now the question arises in this particular case, where is going to be the corresponding debit in this particular case? Same logics would apply. The corresponding debits in this case will be to the P&L or to the OCI or to the equity directly, as the case might be. So I think there is one particular thing, which keeps disturbing a lot of people, and that is as far as dividends are concerned. Now, if you consider that an associate company pays a dividend, I'm not saying declares, I'm saying it pays off a dividend. So when the associate company pays off a dividend, naturally the equity of the associate will fall. And if the equity of the associate will fall, the investor will give a credit to the investment account. Correspondingly, it will be creating, you can say, a bank debit. It would put an entry, a bank debit, or you can say indirectly, if it is receivable, a profit and loss debit. So in this particular case, the dividend received, remember, this is the only exceptions which, arises in terms of the equity method application. Because generally, when you look at the receipt of dividend by the investor, you would always see separate financial statements, it's get credited to the profit and loss statement. But in terms of the equity method of application, any dividends which you receive from the associate company will always reduce the carrying value of the investment. Because the moment the associate company pays off a dividend, the equity is bound to go down. And if the equity goes down, investment gets a credit. So we would put the entry bank debit, investment credit with the share in the dividends which has been paid by the associate company. So which means what? Which means what? If you look at the, if you look at the entire, you can say the analysis, which means what? I would not be wrong in making a very strong statement at this stage, which I will prove it also when I come to the practical illustrations. But I can definitely say one thing, that if you were to look at the carrying value of the investment using an equity method, trust me, if you want to make a cross check regarding the carrying value of the investment as per equity method, you can say, okay, let me take the share in net assets of associate company. Let me consider what is the net assets of the associate company at any given date. Pick up the net assets of the associate company at any given date, take the share in the net assets and add the goodwill identified on the date of acquisition. You will get the investment value in the consolidated financials. So if I want to make a quick cross check, I would say, okay, tell me what is the net assets of the associate company. I'll say, okay, if you say that the net assets of the associate company is, let's say, 120 lakh, I will say I've got a 25% stake in that company. So I will say, okay, the investment should be standing at the share in the net assets 30, plus let's say if you identified the goodwill at 5 lakh, you get the carrying value of the investment at 35. Okay, so that is, I think, the basic concept which I've given you in terms of the equity method of application. Okay, now we need to see some practical illustrations with you, but I think before that, I am going to spend a little time, first of all, to consolidate our learnings today and also give you some, MCQ questions based on our learnings today, which you can apply. So I think let me first now make some mind maps to you, because generally you know that I'm always in a good or I don't know, bad habit or whatever, but in terms of making certain mind maps with you, so that, whatever we have learned in the past almost like 2.5 hours plus, we are able to consolidate our minds. So let's cut down to some key issues, what we have learned today. So I am first going to make a mind map to you. And I think then based on that, I'm going to give you a few questions, MCQs to answer as well. Okay, let's begin the journey. Well, I think there were 3 important lessons which I learned on this Index 28 to begin with. So these are certain key issues which I'm just trying to map in your mind. So there were certain 3 important key issues, what we learned at the start of this standard. So I would say there are 3 things, 3 important inputs which I learned in terms of the standard. Number 1, we learned when does the standard trigger. We learned when does the standard trigger, and we very clearly identified, you can say, 2 very apparent cases in this case. We said that if A has got a significant influence over B, this is one case where B is an associate. So when A gets a significant influence over B, then B becomes an associate and it triggers the concept of Index 28. The second case I gave you is that when A, along with other investors, has got a joint control over B, then B is either a JO or B is either a JV. Because the joint control could lead to a situation where the arrangement is a JO or a JV. Now, if it is a case of a JO, then it is Index 111. It is only if it is a case of JV, then it is Index 28. Then it is Index 28. So these were the 2 apparent situations where we said that Index 28 could trigger, that either with a significant influence, the investee is an associate, or with a joint control, if the investee is a JV, not a JO, not a JO. If it is a JV, then we apply Index 28. I gave you one tricky situation as well, wherein I said that you are a party to the arrangement, but you don't have a joint control. So maybe, while the investors is not a party to the joint control, then he may be assessing a significant influence and he would also apply Index 28, a little offshoot based on Index 111. This was the first agenda which I discussed with you. Then I went to the second important input. And that is the input which I gave you, that, the assessment of significant influence is supposed to be apparently a rule-based, but we also need to apply certain principles in terms of deciding things. But what is important, we said that either you hold a direct percentage or you hold an indirect percentage. So when you're calculating the percentage for the purposes of a significant influence, it could be a direct percentage or indirect. But what is important we learn is that the indirect percentage has to be through a subsidiary only. It cannot be through an associate or a joint venture. So as an investor, if I through my associate or if I through my joint venture holds a stake in the associate company, it is not to be taken. So indirect percentage will be taken only if it is held through a subsidiary. That's another important agenda what we learned. So the triggering conditions, the rules and the principle. So I blended the two things. In terms of the rules I gave you, that a 20% plus 20% or more implies a significant influence and otherwise not. So these were certain important lessons what we learned at the very start of the standard. Then I took it further. And then I started discussing the very first case with you. And the first case is the assessment of significant influence, wherein we saw the concept of assessment of a significant influence. And when you're looking at the assessment of a significant influence, you can say on a very apparent level, it is supposed to be a rule-based concept that if you say you've got 20% or more, then it implies that significant influence is there. And if it is less than 20%, then it implies that there is no significant influence. But this presumption is rebuttable in nature. So this is the presumption which goes without saying that yes, this is a case of significant influence, but I gave you that it is supposed to be a rebuttable presumption. And in terms of the rebuttable presumptions, we have covered both the exceptions. We covered the case when you got more than 20% and still there was no significant influence because your participation technically in the policy making process was not there. So we saw that typically when it is below 20%, then we saw that there are a total of 5 parameters on the basis of which you made an assessment that significant influence is not supposed to be present. And I think if you look at the key highlighted inputs in terms of the 5 parameters which I gave you the parameters in terms of 5. One is you get a representation on the board of directors. The other is you get a participation in the decision-making process. The other one is that you're providing some essential technical information. The other one is that there is an interchange of managerial personnel. So representation on the board of directors, participation in the decision-making, essential technical information, interchange of managerial personnel. And then I also gave you material transactions are there between the investor and the investee. So any of these factors could rebut the presumption that a significant influence is present, even if there is a below 20% stake. This was one area of discussion, and then I went to the second area of discussion with you. And in the second area of discussion, I had given you that typically you can say there are 3 exemptions, and I gave you one particular case where it could be a case of exception. So I gave you 3 cases of exemptions, and you can say one case of exception. Now, if you look in terms of the cases of exemptions, just to remind, exemption is a case which gives you an option not to apply this particular index. It's a matter of choice. So the option means that it becomes a matter of choice for the company. But the case of exception is a case where we can say it is mandatory and you do not have a choice, but you cannot apply index 28. On the very apparent front, you can say the standard only gives you the 3 exemptions. And the 3 exemptions which I gave you is in terms of one is the para number 17, one is the para number 18, and one is the para number 19. And just to have a little quick look at these exemptions which are given, so we identified that typically in terms of para number 17, you can say it is a case of a chain holding. It is basically picking up the same situations what you've done in Indus 110. So this would necessarily follow that as a parent company, you are exempt to consolidate a subsidiary. So by default, you're also exempt in consolidating an associate under Indus 28. Then we went ahead in terms of para number 18. And in terms of para number 18, we saw that you got a direct percentage or an indirect percentage. So you've got a direct or indirect. So if it is a direct percentage, as an investor, you are a VCO or a mutual fund or unit trust. Or if it is indirect, then you can say that your subsidiary company is supposed to be a venture capital organization, mutual fund or unit trust. So either you as an investor is a VCO, etc., or your subsidiary through whom you hold an investment in an associate is supposed to be a VCO, etc. Then in terms of para number 19, we saw that in this particular case, it could be a direct plus indirect percentage. A portion is direct, a portion is indirect, or it could be indirect both ways as well. But what is important is that the indirect portion or one of the indirect portions is supposed to be held through a VCO, mutual fund, and a unit trust. So one of the portions is supposed to be held. Then in that particular case, that portion gets the exemption, but the other portion you have to apply the standard. And in case of the mandatory situation I gave you, typically when you can say that you are, the entity is an investment entity and a VCO both. So on one hand, being an investment entity, you're mandated not to consolidate under 110. So you will be indirectly mandated not to consolidate an associate even under Indus 28. So that was the exception. And then finally, I've just given you a very brief in terms of how the accounting is done under equity method, though we have to do some practical illustrations to that. So we'll be coming to that portion, but I think now it's time to give you some MCQ questions, which you can note down. And of course, I will not give the answers right away. You'll get the answers later, but you just need to decide a true and false statement. Okay, so let's give you the first question for the day. Question number 1. Significant influence may not exist. Significant influence may not exist even if percentage of voting power is greater than 20%, is greater than or equal to 20%. So we said significant influence may not exist even if the percentage of voting power is more than 20%. Number 2. I think that is simple to answer. Number 2. Significant influence implies mandatory application of Indus 28. So we can say that significant influence means a mandatory application in terms of Indus 28. You establish a significant influence and Indus 28 becomes mandatory in nature. Number 3. There are 3 cases where exemption brackets we can say option, 3 cases where exemption, that is option, is given to investor to apply Indus 28. So 3 cases when you get exemption to apply Indus 28. Okay, then next, number 4. There are no exceptions. There are no exceptions. Brackets we can say mandatory. There are no exceptions to Ind AS 28. There are no exceptions to Ind AS 28. I think you know this now as well. I think this is something which people can only answer, if they've understood, what we've done in terms of one of the questions in the education material today. And I think finally, let's also give you another fifth one as well. So that is the number 4. Let's give you another fifth one as well. Can we say at any point of time, investment in consolidated financial statements as per equity method, so at any point of time, investment in consolidated financials as per equity method is always equal to share in net assets plus goodwill computed on date of acquisition. So at any point of time, investment in the consolidated financials as per the equity method is always equal to share in the net assets plus the goodwill computed on the date of acquisition. I think if you have well understood today's lecture, I think you can answer all the MCQs, and I think I might have already got good answers on that. And yes, we've started getting some answers, but I will not give you answers today. I'll give you the answers in the next class on that. So this, I think, brings me to the end of the session today, which was getting a good exposure typically on 2 aspects with you. The focus was not too much on the accounting part, which we're going to lay down in the next class with you on Tuesday, where I'm going to cover the remaining portion of the standard and also give you a little insights on Index 27. Though I think so far Index 27 has not been any major focus in the exam, but still we need to do it. So we'll be concentrating on this equity method and the other issues which I pinpointed in this particular standard. And we're going to do Index 27 as well and wind up the 2 standards in the next class. So over to you, friends, for any questions coming on your side. Otherwise, I think we are done for the day and we're going to call it a day. So any questions, friends, on your side? Okay, I think so far seems to be good enough, I guess. So I think then I can take leave, friends, from you. So that's all for the day, friends. So we're going to see you in the next class. Till then, thank you, take care, and goodbye.